For longer than anyone watching this video has been alive, going back to at least 1940, this blue line, what the United States spends on its entire military, was bigger than this red line. Then, in 2024, for the first time in modern American history, the two lines crossed. Today, the US government spends over $1 trillion a year on a single thing: interest. Not soldiers, not bridges, not schools, just interest. Money paid back to whoever holds the government's debt. This is now the fastest growing expense in the entire federal budget. And in the next few weeks, a new Federal Reserve chairman is going to step in with a plan to make it stop. The plan has been used before. The last time, it took 28 years to work, and somebody had to pay for it. That somebody, almost certainly, is going to be you. Chapter 1: The Box. The US national debt as of this month sits at $39 trillion. Divide that by every American, and each of us is on the hook for roughly $114,000. Per household, closer to $289,000. But the number that matters more isn't the debt itself, it's what we pay just to carry it. Over $1 trillion a year in interest payments, roughly $3 billion a day, every day, just to service old promises. Here's the part that should worry you. The average interest rate on that debt has gone from 1.5% 5 years ago to over 3.33% today. The bill is repricing in front of us. Just so we're on the same page, when the US government borrows, it issues something called a Treasury. Think of it as a loan. You give the government cash, you get a piece of paper promising to pay you back, with interest, on a specific date. Here's what nobody talks about. Roughly 1/3 of all that publicly held Treasury debt comes due in the next 12 months. The average maturity across the entire $39 trillion is just 70 months, and falling. Why does that matter? Because we just put a $39 trillion debt on something close to an adjustable rate mortgage. If interest rates rise, the bill reprices upward, fast. If they fall, the bill reprices down, just as fast. That number, that 33%, is going to come back at the end of this video. Just so we're on the same page on this one too, the Federal Reserve isn't actually federal. Its own website says so. It's structured to be independent of the government. The president doesn't tell it what to do. He can only choose its leader when the seat opens. That seat opens May 15th, 2026. Powell's term ends. Most people expect Trump's nominee, Kevin Warsh, to take over. And here's where almost every commentary on this gets it wrong. Warsh is not Trump's puppet. Warsh is a hawk. He sat on the Fed board from 2006 to 2011 and resigned in protest over money printing, not because he wanted more, because he wanted less. When senators asked him directly under oath if he'd promised Trump rate cuts, he said, "The president never asked me to commit to interest rate cuts." And yet the bond market is still expecting him to make government debt cheaper. How does a hawk end up serving doves? That's the story. Before we get to that, context. There's a war on. The 2026 Iran conflict has pushed Brent crude to around $96 a barrel. Gas at the pump in parts of the US has crossed $4 a gallon. CPI hit 3.1%, up from 2.4% in February. The market response? CME FedWatch, the bond market's pricing tool, now shows 0 rate cuts for all of 2026, down from 3 cuts expected at the start of the year. So Warsh walks into a Fed the market thinks won't cut, a debt the country can't keep paying, a war making everything more expensive. That's the box. Chapter 2: The 1946 Playbook. Governments at this scale don't pay debt back. They never have. There's only one way out, and the United States has used it before. The last time was after the Second World War. The man in charge of the Federal Reserve back then was sitting in the same chair Warsh is about to sit in. His name was Mariner Eccles. The building the Fed runs out of in Washington is named after him. There's a reason. In 1946, the US came out of the war with debt held by the public at 106% of GDP, the all-time record. Today, we're at roughly 120, headed for 140 within a decade. Same crisis. The fix back then wasn't paying it back. The fix was Eccles' Fed agreeing with the Treasury to cap interest rates. 0.38% on short-term debt, 2.5% on 30-year bonds. Hold that ceiling while inflation ran loose. By February 1951, inflation hit 21%. If inflation is 20% and the bond pays 2.5%, every year you hold that bond, you lose 17.5% of your money in real terms. The lender bleeds, the borrower wins. The borrower was the US government. This has a name: financial repression. Interest rates below inflation. Lenders lose real value. The debt shrinks without anyone ever cutting a check. By 1974, debt to GDP had fallen from that 1946 peak to around 30%. Berkeley's Eichengreen calculates 68% of that fall came from this mechanism, only 38% from actually paying anything back. 2/3 inflation, 1/3 surplus. But the formal yield cap part of the playbook ended much earlier, in 1951. Here's how. Inflation got too hot. Eccles and the Fed broke publicly with President Truman. The result was the Treasury-Fed Accord, signed March 4, 1951. It ended financial repression. It restored Fed independence. It is the foundational document of the modern central bank. Now, here's what Warsh said on CNBC just last year, in his own words. We need a new Treasury-Fed Accord, like we did in 1951 after another period where we built up our nation's debt, and we were stuck with a central bank that was working at cross purposes with the Treasury. That's the state of things now. The 1951 Accord is famous for ending repression. Warsh wants a new one, flipped to coordinate repression. Same name, opposite direction. This isn't reading between the lines. This is what he literally said, to CNBC, on camera. So what does the plan actually look like? Per analyst reads at PIMCO plus Warsh's own testimony, rates drift from around 3.75% down to 2.75% over the next 12 months. Inflation stays close to 3%. Real interest rates drop below 0%. Without an announcement, without a crisis, without anyone calling it what it is. The Fed sells off bond holdings, the Treasury issues more short-term debt at the lower rate, government borrowing costs fall, and the lender, meaning savers, banks, foreign holders, you, eats it. Elegant, gradual, hidden in plain sight. And it has one problem. Chapter 3. The Repression Window. Now you might say, if it worked from 1946 to 1974, why not now? 3 reasons. 1. Duration. In 1946, the Treasury locked in 30-year bonds at 2.5%. They had decades to inflate the debt away. Today, remember the 33% number? A third of the debt rolls inside 12 months. Repression has to work fast. If it doesn't, rolling debt prices up instead of down, and the math collapses. 2. Savers have somewhere else to go. Eichengreen, December 2025. The deregulatory toothpaste can't be put back in the tube. In 1946, U.S. banks were legally forbidden from offering competitive deposit rates. Today, money market funds, foreign ETFs, gold, crypto, 50 exits. 3. The bond market is faster than it used to be. Here's what I mean. In September 2022, Britain's new Prime Minister Liz Truss announced big tax cuts with no plan to pay for them. The people who lend money to the British government took one look, decided British debt was suddenly riskier, and started dumping it all at once. Interest rates on British government bonds spiked in 72 hours. Pension funds nearly collapsed. The Bank of England had to do an emergency rescue. 45 days after she took office, Truss was out, shortest-serving prime minister in British history. The market killed the policy before the policy could do anything. The US bond market is roughly 20 times bigger than the UK's. When it moves, it'll move bigger and faster than the Fed can react. So how does this play out? 2 scenarios. Orderly. The more likely one. Warsh gets his accord. Rates drift to around 2.75. Inflation runs around 3. Real yields stay slightly negative. Asset prices keep climbing. Savers eat 1 to 2% of real losses every year for 5 to 10 years. Debt to GDP slowly stabilizes. Most people never notice they're paying for it. Disorderly. Iran keeps oil elevated. Inflation reaccelerates. The bond market stops believing the Accord story. Long-term yields spike. Mortgage rates above 8%. Foreign holders, Japan, China, and the UK, accelerate the trend they've already started. Debt service crowds out everything else. The US hits what economists call fiscal dominance, when the size of the debt determines what the Fed can do, not the Fed's mandate. Britain 2022 scaled 20 times. This is the tail risk Warsh is going gradual to avoid. So what do you do with this? The mechanism is designed to make cash lose. That's the point. Holding too much cash for too long is a guaranteed real terms loss in the orderly scenario. Real assets, equities with pricing power, real estate, gold, a small Bitcoin allocation are how households historically survive financial repression. The easiest way to see it: savers lose, asset holders win. Long-duration bonds at below inflation yields are the worst place to be. That's literally what 1946 trapped savers in. Watch for Treasury issuance shifting longer duration, regulatory talk around bank or pension Treasury holdings. That's the 1940s replay, the June Fed dot plot, the Iran ceasefire status. Want to know which chart has historically appeared before almost every major recession? Today it's signaling a downturn that could be worse than 1929 or 2008. To understand what that means and why it matters, tap the video on your screen. I'll break it down.